I own gold bullion because it helps me sleep nights. And at age 71, that's a real benefit. I do own silver stocks. And I own silver stocks because towards the middle of a gold bull market, through the end of the gold bull market, historically, there is no asset class that performs as well to the upside as the silver stocks. The population of legitimate silver stocks is very small, and their combined market capitalizations are very small. 4 times before in my career, the precious metals narrative has been such that the generalist investors go first into the gold equities, but later into the silver equities, and the combined market capitalizations of the silver equities, we'll call that the silver silo, is so small that it can't handle the influx of capital that comes in. And the results can be very dramatic, Michael. I remember in the decade of the 70s, when I was too young and too dumb to play well, Coeur d'Alene Mines went from 10 cents a share to $65.
So we're one day removed from the, in quotes, historic Fed decision, 50 basis points. You're well versed in all commodities. I'm curious, which commodity do you think benefits the most from the Fed easing?
I think in the near term, and I define the near term as a year, gold. Gold, in my experience, has done particularly well when people are concerned about the maintenance of purchasing power in their domestic currency. This Fed decision is really interesting. We're told we have a great economy, and the equities market would suggest we have a great economy. If we have a great economy, why do we need a 50 basis point rate cut? That's of interest to me. A broader topic, I think, Michael, around gold is the fact that if you believe, as I do, that the gold price does well when people are concerned about the maintenance of purchasing power in fiat-denominated instruments, let's do a little bit of arithmetic. The government would have you believe that inflation, their measure of the deterioration of the purchasing power of the U.S. dollar, according to the CPI, is cruising along at 2.6. If you believe that, earning 4.2, 4.3, or now 4 in the U.S. 10-year Treasury isn't a bad deal. You get paid 4% real yield in a currency depreciating by 2.6% a year. You get a positive real yield. I don't believe those numbers, Michael. I do a thought exercise every year, and I have for 6 years, around the pricing of the basket of goods and services that I consume in my life. The government, when it's inconvenient, doesn't include food or fuel. Unlike you, Michael, I'm not on a fast. So the price of food is of some import to me. Importantly, the government number in the CPI doesn't include the cost of government itself, while tax is usually the largest component of every household budget, every working family in the United States. If you believe, as I do, that the deterioration of the purchasing power of the U.S. dollar is more like 7.5 than it is to 2.5, then the fact that you're getting paid 4% on your 10-year Treasury, on your deposit products, in a currency that's depreciating by 7.5%, means that the money that you're saving is losing you 3.5% a year in purchasing power. There is nothing in the world that would cause me as much concern about the deterioration of my purchasing power as that simple piece of math. Cutting the reference rate, cutting the Fed rate, cuts the yields on other savings deposits, while at the same time likely increasing the deterioration of the currency in real terms. And I would suggest that the beneficiary of this, once that arithmetic comes to be felt in the market, will be first in the gold market.
At what point does that deterioration of purchasing power really impact societal motivation? I mean, why would anybody work as hard as they're working if it's just going to be taken away?
That's a wonderful question, Michael, and I'm going to attempt to answer it. I would note that I'm a credit analyst, not a social psychologist. So my answer is going to be necessarily dry. I came into the business in the decade of the 70s, and the circumstance that confronts us now confronted us in 1968 when I was a little too young to understand it. But it was pretty clear after having fought the war in Vietnam and the war on poverty that we had more obligations as a society than we could service. It became fairly obvious, too, that we couldn't raise tax to cover the net present value of our obligations. So what we did in the period 1970 to 1981 is that we reduced the purchasing power of the dollar through inflation by over 80% in 11 short years. The consequence of that is that the gold price, of course, went from a price-controlled $35 an ounce, pardon me, to a price in excess of $800 per ounce. What's germane to the question is that the writing was on the wall around inflation beginning in 1968, but it didn't become a matter of popular concern until 1972 or 1973. If you dial back to that circumstance, if you dial back to those days, we had experienced very, very, very buoyant economic conditions from the end of World War II, say 1946, all the way through 1968. The Nifty 50 is an example, the wonderful growth of American hegemony around the world, the strength of the US dollar, and people were conditioned to be optimistic. I would suggest that we have lived through an even longer and even more beneficent circumstance from 1982 to 2022. Wonderful wonderful strength in the US dollar, wonderful equity markets, wonderful bond markets, a lot of animal spirits, people being trained to buy the dip, people not being afraid. I personally believe that this beneficent epoch that we enjoyed, this 4-decade epoch, came to an end in 2022. And I personally believe that there will be a lag in psychology from a psychology of boom to a psychology of caution. By the way, I'm not calling for the Greater Depression. I'm not calling for the end of the US dollar. I'm not doing all that doom and gloom stuff. All I'm saying is that there is going to be a reckoning as a consequence of the obligation that our society favors. And that reckoning, I think, almost necessarily results in the continued and accelerated depreciation of the purchasing power of the US dollar, and increasingly, too, a recognition of the benefits of gold, a recognition that we last saw to this extent in 1970 to 1982, but we also saw in fairly dramatic form in the period 2000 to 2012.
You use the term price controls, and I'm curious, given that there are concerns that the Harris administration would usher in price controls. What's the history of price controls and commodity prices?
Well, price controls really has a track record unblemished by success.
Yeah.
If you look back to markets where they had price controls, what you ended up having was a supply control. You also had a diversion of revenue from the people who could increase supply, which is to say private industry, to those who always constrain supply, which is to say the U.S. government. It may be that price controls become popular again. I don't know. My hope is that an examination of history will cause even our political elites to be less stupid in the future than they have been in the past. I've never seen price controls work. Let's look at New York City, the consequence of rent controls. Slums, underinvestment in rental construction, a lack of availability of rental accommodation, a track record, as I say, unblemished by success. Successful, of course, for those people who were able to obtain rent-controlled units in the 1970s and 1980s and enjoy substantially below-market rents today at the expense of the broader community. Price controls never work. Markets always work. The cure for low prices is always low prices. The cure for high prices is always high prices. But markets are messy. They take time. Markets have victims. Markets have beneficiaries. The victims are always covetous of the beneficiaries. The victims are also more numerous and they vote. I am not buying silver bullion. I have a fairly large position in gold bullion. By the way, I'm stupid to do that. I'm the largest shareholder of Sprott Inc. And if the gold market and the silver market run, in theory, the most important brand name for retail investors in gold in North America is Sprott, I will do well. But I own gold bullion because it helps me sleep night. And at age 71, that's a real benefit. I do own silver stocks. And I own silver stocks because towards the middle of a gold bull market, through the end of the gold bull market, historically, there is no asset class that performs as well to the upside as the silver stocks. The population of legitimate silver stocks is very small, and their combined market capitalizations are very small. 4 times before in my career, the precious metals narrative has been such that the generalist investors go first into the gold equities, but later into the silver equities, and the combined market capitalizations of the silver equities, we'll call that the silver silo, is so small that it can't handle the influx of capital. that comes in. And the results can be very dramatic, Michael. I remember in the decade of the 70s when I was too young and too dumb to play well, Coeur d'Alene Mines went from 10 cents a share to $65. In the latter part of the decade of the 80s, before that wonderful bull market that happened 91 to 96, I was able to finance two small silver companies. One, Pan American Silver at 50 cents. The other, Silver Standard at 72 cents. 6 or 7 years later, both of those stocks had crested through $40. So when I say that in a silver bull market, the asset class that performs most dramatically to the upside is silver stocks, that is an indication. I was vocally bullish about silver stocks in December of last year and January of this year, for the simple reason that there was so much hate concerning them on social media. I determined that from my own viewpoint, almost everybody who wanted to sell had sold because there was no love, there was only hate. The consequence of that is that that subset of silver stocks has done very, very well, up about 50, 60% in the first, 7-8 months of 2024. In direct answer to the question, about 2.5% of my total portfolio was invested in silver equities. That has become about 3.5% of my portfolio, not because I've added more money to it, but simply because the prices of the small silver stocks has outperformed most other asset classes in the ensuing period.
You mentioned your career history financing some of these companies. I don't really hear too much talk about the bond side when it comes to mining entities. It's always focused on the equity side. Are there perhaps better opportunities or maybe more mispricing on the fixed income end of things?
Occasionally on the fixed income side of things, you need to be able to understand the net present value of the security around the bond. And you need to understand the covenants, conditions of restrictions. Understand that exchange traded bonds are originated by investment banks to earn a fee from the issuer. So the covenants, conditions, and restrictions on the bond are as light as the investment banks can make them in order to extract the fee. I happen to love being a bond investor. I also, it should be noted, have been active for 30 years in private credit agreements with public mining companies, not in the form of bonds and not in the form of investment grade securities. The business that is now Sprott Resource Lending started life as something called Quest Capital with me as a co-founder. And I have been active for 30 years providing private credit to public issuers in natural resources, which is a wonderful business. When people refer to junk bonds, when they refer to the risks inherent in bonds, they need to understand that the worst piece of debt is better than the best piece of equity on any individual balance sheet with regards to security. It's all in the collateral and it's all in the covenants.
I think the commodity cycle discussion is an important one. You mentioned gold. Let's talk about some of the industrial commodities for a bit. It seems like the industrial commodities need to have maybe China to have a comeback to get any kind of real sustained momentum. Am I wrong on that thesis?
You're both right and wrong. It's a function of time. In most industrial commodities, humankind has been underinvesting in productive capacity around those commodities for a very long time. So that even current levels of demand will, in the 5, 6, or 7 year time frame, exhaust our ability to produce them. We continue to underinvest in such commodities as copper, nickel, platinum group metals, nutrient materials like potash and phosphate, and oil and gas. So that if the pace of investment, the pace of productive capabilities doesn't increase, normal demand will overwhelm supply. The only reason that wouldn't take place is if we had a synchronized global recession or depression. If we don't have a synchronized global recession or depression without the renewed vigor of Chinese expansion, but rather simply demographic trends, demand, even if it just held steady at today's rate, begins to overwhelm our ability to supply in a period as short as 5 years. When you look at commodities even much larger than copper, I'm thinking precisely oil and gas. One example would be that while the market suffers from a near-term oversupply as a consequence of abundant credit, a low cost of capital in the United States, and also the conjunction of various technologies, things like horizontal drilling, management by wide drilling, three-dimensional seismic, stimulation and fracture technology, that producing surplus goes away in as little as 2 years. It's important to note, and I'm not saying to buy oil stocks, I'm using this as an example. It's important to note that on a global basis, if you include state-controlled firms, we are underinvesting in sustaining capital in the oil and gas business to the extent of about $1 billion a day. In a capital-intensive business, if you don't maintain sustaining capital expenditures, what you do is you reduce your ability to produce in the out years. Examples of this would be the National Oil Company of Mexico, Pemex, which has diverted free cash flow from their national oil and gas business into politically expedient domestic spending programs, including, ironically, subsidizing the price of gasoline, where the productive capacity of Pemex in the last 30 years has declined by 80%. A more dramatic example would be PDVSA. Arguably, Venezuela has the largest total petroleum reserve in the world. And as a consequence of the diversion of free cash flow from PDVSA, again, to politically expedient domestic spending programs, the producing capabilities of the state oil company that controls the largest reserves and resources of oil in the world has declined by 85% over the last 25 years. I point this out because if we do not turn around this reduction in capital spending, you are going to see tight oil supplies in a period of time as brief as 2 years or 2.5 years. And this problem isn't confined to oil. It exists in the copper business. It exists in a variety of businesses. If we have a global economic slowdown where you reduce demand, then you can see supply reduce without upward pressure on price, because prices are, of course, set at the intersection of supply and demand. If we don't have an economic slowdown in the next 5 years, I think it's a virtual certainty that we see price escalations in a whole range of industrial commodities as a simple function of historic underinvestment in productive capacity.